Welcome to 5 accounting basics that you wish you didn't need to know. Fundamentally, accounting is an information science used to collect, classify and interpret financial transactions for organisations, governments and individuals. Financial transactions are recorded in journals in chronological order, which, over time, create a financial story. Bookkeeping, which is part of the accounting process, is a recording and coding of where the money comes from and where it goes. Accounting is the processing, systems, communication, interpretation of financial information about a person, a company or an agency. Like other professions, there are specialisations within accounting. For example, financial accountants focus primarily on external stakeholders through compliance or legislative reporting. Specific standards and formats may be required. There are often strict timelines associated with producing these reports. Management accountants provide information to people within an organisation. Reports are prepared to assist with informed decision-making through providing specific data and/or analysis. Other accounting specialisations include tax, audit, treasury, insolvency, financial planning and the public sector. The whole point of accounting is to present a precise financial picture of an organisation's business operations. When financial transactions occur, each activity will touch at least one of the 5 elements of accounting. The 5 elements of accounting are assets, liabilities, equity, revenue, also known as income, and expenses. For official definitions, you should visit the Australian Accounting Standards Board at this website. Whatever jurisdiction you're in will have their own accounting standards. The 5 elements of accounting make up 2 of the most common financial statements organisations consider when making decisions about the value of a business or the performance of a business. Let's look at the first 3 elements. Assets are all the items owned and controlled by the organisation which have future economic value and can be measured and expressed in dollars. These include items such as land, buildings, shares, cash at the bank, vehicles and accounts receivable. Some of you might be thinking, hang on, why aren't staff listed here as assets? Because the definition of an asset is that the organisation owns or controls it. Sadly, staff can call in sick, quit without notice and occasionally have more uncontrollable behaviours. Also, you can't sell them. Therefore, staff aren't assets as they are not ultimately controlled by the organisation. Liabilities. This is money owed to others. This is things like accounts payable, loans, credit cards, mortgage, long-term leases. Equity is the difference between the two, and it's how much the organisation is worth. These first 3 elements make up the balance sheet, which details the financial position of the business. They are also the elements of the accounting equation. Assets minus liabilities equals equity. Balance sheet is a statement of the assets, liabilities and equity of a business at any particular point in time. Here's a simple example of a balance sheet detailing what the company owns and owes and the resulting net worth. In your personal life, your balance sheet, your financial position, might look something like this. There's 2 remaining elements: revenue and expenses. Revenue is what you earn, your sales, dividends, etc. Whereas expenses are the costs of doing business. Wages, insurance, office supplies, rent, it goes on. These 2 elements, revenue and expenses, make up the profit and loss statement, also known as the income or operating statement. This statement details the financial performance of an organisation. Here's a simple example of what an organisation's profit or loss statement might look like. Similarly, each pay period you could run a profit and loss statement. It might look something like this. The best outcome is having some money left at the end of a pay period for investing in yourself with things like holidays, buying a house, saving for retirement, etc. For a business, the best outcome is having money left over to reinvest back into the organisation for new equipment, etc. Without the information supplied by good accounting practices, there'd be no basis for organisations or governments on which daily and long-term decisions could be made for developing budgets, investment in research and development, buying new equipment, or developing new products or services. For individuals, understanding where your money goes can be very helpful, especially when going to the bank for a loan. The banks will consider your financial position, how much you owe and own, your balance sheet, and your financial performance, what money is left over at the end of a pay cycle, before lending you any money. Here are some useful websites for those who want to know more about accounting standards around the world. Quick disclaimer, this is information only. Please consult your organisation's financial professionals or your own accountant before making any financial decisions. But what are debits and credits? Accruals? Depreciation? Chart of accounts, I hear you ask? Or maybe you didn't.